Another point I'd like to make about gold is that it's not an investment, it is money. The comparison you've got to make is how frightened are you of the fiat money system? Therefore, how much are you going to have out of the fiat money system? That is what you've got to decide, and it's probably the most important decision of anyone's life, particularly over the next 2 or 3 years.
This week's specials with Miles Franklin Precious Metal Investments. Austrian Philharmonics for only $365 over spot. Type 2 Silver American Eagles for only $725 over spot. And limited mintage San Francisco Mint Type 2 Silver American Eagles for only $725 over spot, sold in quantities of 500. Call us at 1-888-81-LIBERTY. That's 1-888-815-4237.
Welcome back to Liberty and Finance. We have a returning guest who is widely anticipated by our viewers. This is Alasdair MacLeod. He's a former bank president. He's a research analyst. He's the head of research at goldmoney.com. He joins us this Tuesday, August 14th, 2021. Alasdair, thank you for joining us again.
Nice to be with you, DK.
About a year ago, perhaps more, it was a little bit over a year and a quarter ago, you sounded a caution to alarm, really, to tell people that you saw an impending banking crisis, credit crisis, and a currency crisis. And those things have been forestalled by various mechanisms and machinations of those in charge of the system. However, we were just talking a moment ago about the sharply increased level of anxiety and anxiousness that I'm receiving from clients who reach out to me saying over and over, many different people saying, I just want to get my funds out of the bank. I want to get my funds out of the market. I want to get my funds out of my retirement account, and I want to get them into something that's away from the grasp of these sort of unprecedented, overreaching jurisdictions that are happening. So could you bring us up to date on what you are seeing that's going on right now, and either has been announced or hasn't been announced, that's corroborating this anxiety that we're picking up from the grassroots?
Yeah, sure. When I was talking to, it was probably as much as a year ago, it's time flies, about an impending banking problem. I was really referring in particular to the European Union. The banks in the Eurozone are effectively, I mean, not only are they illiquid, but under any metric, they are bust. But it's been concealed by pushing all the bad debts out from underneath the noses of the national banking regulators into the Target 2 system. So we see the imbalances in Target 2 increasing, but the banks are still there. They're still horribly geared. Their share prices have rallied somewhat, but that's probably more in line with the market. But they're still standing at huge discounts to book value. And, normally, in a normal market, if you see a stock standing at a discount to book value, you look at it and you think, well, it's an opportunity to buy something at less than book value. But in the case of these banks, you're looking at operational gearing, the relationship between assets and shareholders' equity on the balance sheet, of over 20, even 30 times. I mean, these are huge numbers, and it doesn't take much to go wrong. And that is what the share prices of some of these GSIBs, global systemically important banks in the Eurozone, are reflecting. So the problem is still there. It's been hidden. And of course, it's not something that can go on forever. If you do get a problem in something like the Eurozone, then obviously it's got implications for other banks, because all the banks are interconnected because of the internationalization of finance, if you like. Funnily enough, the one nation's banks which are probably best capitalized are the Americans. So it might seem a little bit odd, if you like, for your predominantly American audience to worry about, deposits in their banks. But I think what I'm detecting from what you're saying is there is a wider concern about the political situation, what's happening to money. Its currency and credit are being printed at accelerating rates, and there seems no end to it. And meanwhile, financial assets are very definitely in a bubble. You have government bonds are completely mispriced virtually everywhere in the world. I mean, just to put that in context, the rate of inflation, according to the official CPI today, is 5.3%. Yet the yield on something like a 10-year US Treasury bond is around about 1.3%. It's a little bit less than that. And so you have got very high negative real yields in the market. Now, that can't persist forever. Either the rate of price inflation is going to come down, or bonds are going to come down. It's one or the other. And I think if anyone suggests that the rate of inflation is transitory, as indeed the Fed have tried to do, I think is, sort of whistling, really. I mean, it's just not true. But getting back to your theme, all these concerns are very definitely concerns. But rather than getting out of the banking system, I think the only thing that an individual can do is basically get out of the fiat money system, because that is the problem. It is the fiat money system. So how do you get out of the fiat money system? Well, the answer basically is you don't hold currency, because currency is, if you like, it is effectively a bearer deposit issued in the form of a note from a central bank. So it's a liability of the central bank. A deposit in a commercial bank, or private bank, if you like, is, it is money owed to you. It's not your money, it's owed by the bank. And the other side of that is credit that the bank has given to someone else. So really, I think what you're talking about is getting out of the fiat money system. And there is only one way you can do that, and that is to get into something which has no counterparty risk. And that is gold and silver. It's actually, that is your only choice. That's the only way out of that situation.
I was going to say earlier, when you were talking about people getting this anxiety about the banks, I think you're right. It's not so much necessarily the banks, it's the fiat currency itself, and that puts your finger on it. And that leads to the next question: is what comes after this fiat currency, if its days are numbered? And there's a couple questions here. One is about the Chinese yuan being potentially backed by gold in the future. The other is about central bank digital currencies. Maybe let's take those one at a time. There's the first, Marty F. says, if and when China announces that their digital yuan will be backed by gold, will this force the U.S. to make a public audit of its gold reserves? Also, will this action drive the spot price extremely high? This would then force gold out of personal holdings onto the market. That's one question about gold. There's another one about gold which is related. J.D. Smith says, is the U.S. buying up gold at the rate Russia, China, Afghanistan, India, and the rest of the East is, or are our leaders burying their head in the sand? We should be at the table for the Great Reset. Both of those questions talking about Great Reset, both talking about gold-backed currencies. Tell us what you think is going on with China and the future of that.
Well, China, I mean, there's a very big geopolitical situation here, because America, having pulled out of Afghanistan, has effectively sent the signal that it's leaving the whole of the Asian continent, and that includes Eastern Europe, in the hands of the partnership between Russia and China, which is, if you like, sort of formally represented by the Shanghai Cooperation Organization. And indeed, the Taliban, before they took over Kabul, had a meeting with the Shanghai Cooperation Organization. And the deal basically that was done was they will help support a Taliban government in Kabul, on condition that the Taliban ensures that there is no terrorism fostered within Afghanistan and released into the neighboring states. So the the Taliban has to be entirely ruthless in terms of dealing with factions, if you like, Islamic factions within Afghanistan. That's the basis of the deal, and so America is out of it. So the reason I mention this is it obviously has long-term implications for the dollar and the yuan and also gold. I think what we're seeing is the dollar decline in terms of its overall importance. Now, it's not something that happens immediately. We're talking about an end of empire, which in the case of Rome lasted 400 years, from its peak. In the case of America, it could take the next 5-10 years, depending on events. It could even take slightly longer. But as I say, depending on events, because there's quite a lot of violence, financial violence within the global monetary system, which could upset anything, really. As far as the Chinese yuan is concerned, China obviously sees that she is in the winning position, and she's managed to achieve that basically by not upsetting the apple cart. And I don't see China taking an aggressive move against the dollar. I think that's extremely unlikely. I think what she's more likely to do is just let the dollar cook in its own juice, if I can put it that way. So this brings us on to the relationship between the yuan and gold. I've always thought that the announcement of the yuan's, or China's true gold reserves, was something that would be a bit of a last resort as far as China is concerned, because obviously to suddenly turn around and say, we don't have 2,000 tons, we've got 20,000 tons or 30,000 tons or whatever the figure is, would have a major impact on international currency markets. I mean, it would be bound to. You would really be undermining the whole of the sort of post-Nixon ethos that the dollar is the international currency. It is the reserve currency and not gold. So you can see that would be a very, very major event. And China isn't about to go on, do that, unless America does something really stupid and leaves China no option but to take action to destroy the dollar. So, but I just don't see that. I mean, that is not on anyone's agenda at the moment. As far as America and gold is concerned, I'm afraid that there's a little bit of a sort of two-way pull on this. There is no doubt that both the U.S. Treasury, and particularly under Janet Yellen, and also the Fed, do not regard gold as money. It's as simple as that. Having dismissed it, it was dismissed 50 years ago. Exactly 50 years ago as money, as far as the American establishment is concerned. And they're not about to start thinking, hold on a minute, were we right to do that? So I just don't see that there is any interest, if you like, in gold as a monetary asset in the American government establishment. That's the first thing. The second thing is that they do recognize that ownership of gold is still a rival to the dollar, and they remove it wherever they can. For example, when the Ukrainian situation blew up, allegedly, someone arrived and took away all the gold, and it was believed to be American, either CIA or something or other. The same happened with Libya, the same is sort of happening with Afghanistan, in the sense that anything that Afghanistan owns, which is held at the New York Fed, has just basically been frozen. So you can see that, on the one hand, the administration in America does not accept officially and even unofficially that gold has any role, monetary role at all. But at the same time, they recognize it's still some sort of lingering threat, and they better have what they can to take it off the market, as it were. So I think that's the way I would look at the Americans' official and unofficial view on gold. I don't see them, therefore, adding to gold reserves. I mean, we don't know what the gold reserves are because there hasn't been an audit for an awfully long time. And if circumstances were to change such that America would have to consider going back onto a gold standard, then obviously there is a loss of confidence in terms of what America actually has that would have to be addressed. But I think that's going down the road a little bit from where we are today, and we would see how things evolve.
Still on the line of a central bank digital currency, we have another question from D. Martin 22222 who says, "Hey Alasdair, what are your thoughts on the central bank digital currency? Specifically, do you see them just rolling it out over a weekend after saying the Friday before that everything is healthy and we have nothing to worry about? Or do you think it will be rolled out as the solution after a crash of the almost everything bubble, letting most of the population be wiped out first?"
I think the first thing to say is that the point about a digital currency is that it means that everybody, and now whether everybody is actually everybody or everybody in a certain sector, whether it's, I don't know, sort of large businesses or whatever it might be, or people involved in foreign transactions. I mean, whatever it is, they will have to have accounts at the Fed. Now, that is a major change because at the moment, the only people who can have an account at the Fed basically are the commercial banks. That has been widened in terms of reverse repos to include some of the money market funds, I understand, but whether they've still got to go through banks or not, I'm not entirely sure at the moment. So there are huge administrative hurdles to overcome before you're going to see the introduction of a digital currency. I think before then, we're likely to see some announcements about how it might progress, assuming that the Fed is, moving in that direction. In terms of whether it would be introduced to replace a failing dollar, that I think could be on the minds of some people within the establishment, because not everybody is sort of such rabid neo-Keynesians or MMTers within the organization of the Fed and the Treasury that they don't see that there are potential dangers, if you like, to the fiat money system from all the monetary inflation that's going on. And I have no doubt that, they would sort of toy with the idea that this would be a potential replacement if a crisis occurs, really because they would hope that they could probably manage the exchange rate. I mean, by the exchange rate, I mean the rate at which the digital currency is exchanged for goods and services in the economy. They probably feel they could manage that better than doing something at arm's length, where the bulk of money is actually created in the form of bank credit by commercial banks beyond their control. So, yeah, we can see that. I think, however, there is a lesson in this, and that is that if there is enough time for them to introduce such a thing, it's rather like the situation in France going way back to the time of the Revolution. Those that weren't there might reflect on the fact that the French revolutionary government created the assignat, which basically was a currency secured on church property, which, was sort of theoretically convertible into property at some stage. Initially, it was very successful, but they continued to issue increasing tranches of this in order to finance the situation, if you like, the government situation, to the point where it started losing value tremendously. So what did they do? I mean, the assignat was hated because it just collapsed in value. Not entirely, a bit more like the sort of Venezuelan situation, I think, where there was some sort of residual value at the end of the day. But so what do? They introduced a new currency called the territorio mandat. And that it lasted 6 months. I mean, the answer basically is that if a government proves that it cannot resist inflating its currency, then it doesn't matter whether you replace it with anything else. unless it's convertible into physical gold, because having established that it hasn't got the responsibility to actually manage a currency properly, then nobody's going to believe it second time round. So I think the fate of digital currencies is likely to replicate what happens to fiat currencies. So. But I don't think necessarily there is that much time. I mean, on your show before, I've talked about the John Law situation. And the more I think about it, the more I think that is the template for what we have ahead. We have a financial bubble. Equities continue to rise, well, sort of at the moment. They are wildly overvalued on any metric, other than close to zero bond yields. So when they start going up, which is an inevitable consequence of monetary inflation, then the bubble is going to pop. And what happens then? Well, I mean, what John Law did basically was he printed more livre, which was the currency he had control over, in order to support the bubble. And it just meant that the livre collapsed entirely after about 6 months. So by tying the fortunes of a fiat currency to financial assets, when that bubble pops, it takes the currency down with it. So this is something that happens, I think, relatively quickly once it starts. It's not like the German inflation situation, which took 4 or 5 years to get to the point where it started going hyper, as it were. So I think the John Law thing basically means that once things start falling, and we're talking about financial assets first, once they start falling, then fiat currencies' days are numbered. It's as simple as that. And it probably won't take terribly long to take them down.
A related question about how this would play out and affect the ordinary investor or banking customer. Richard Edivine from the UK says, here in the UK, small deposits and currency accounts are covered by a government guarantee up to £85,000. But the government has no money and is funded by the taxpayer. So if the banks fail, our government would have to print or borrow this money into existence. Would this be inflationary? How do large firms and billionaires protect their cash? Many thanks for helping the ordinary people, he says.
In terms of whether it's inflation, I mean, he's right to point out that, the money has to come from somewhere, and it will probably come from borrowing, as it were. But the first objective of the Bank of England in a crisis will be not to have to rely on, deposit guarantee schemes to bail out depositors. They will bail out the banks. I mean, make no mistake about it. They're not about to let the banks go bust. And the same is true everywhere. And this is why what's going on in the Eurozone is they're just hiding all the evidence. And the same would be true, I think, in the UK. I mean, we've ever since, certainly before Napoleonic times, whenever there has been a bank crisis, it's something which happens regularly, once every 10 years, roughly, throughout the 19th century. And certainly from the sort of 1820s, 30s onwards, I mean, the Bank of England became more and more involved, if you like, with trying to ensure that a crisis was managed rather than a crisis actually took everything down. And the result was, yes, we had crises, but nothing was really as catastrophic as what we potentially face on the expiry, if you like, of fiat currencies. I mean, would it be inflationary was another question. Well, what you could do is you could take the view that if bank credit collapses because depositors are withdrawing, I mean, what would have to happen is that the banks would have to call in loans in order to keep the balance sheet, sort of balanced, as it were. Alternatively, the Bank of England would have to chuck money into the banks, maybe by buying equity, maybe by taking them over, whatever. That would be inflationary. Yes, that would be inflationary. But if it's just a question of the bank customers being bailed out by the government, then under those circumstances, it would not necessarily be inflationary because you've got to offset the deflationary aspect of depositors being bailed out, if you like, with the bank collapsing its outstanding bank credit. I don't think it's something that's going to happen. What you will see is the banks rescued rather than allowed to go bust in that sense. There is one aspect of this which I haven't mentioned, and that is the difference between bailouts and bail-ins. After the Lehman crisis, virtually every G20 nation passed laws or regulations to authorize the central banks to do bail-ins as opposed to bailouts. Now, in the question of a bail-in, basically what happens is that the cost of it is shifted from the government, the state, to bondholders and large depositors. Now, I think if they tried that, it would be complete chaos. I mean, it would just, you would get a complete collapse of the system because everybody would be trying to get their money out. Where they would go, there's only one place they could actually go, and that is either into government stocks. In other words, paper outside the banks, as it were, or alternatively into gold and silver. Because I always come back to this point. If you're worried about what's going on in a fiat money system, there is only one way to get out of it, and that is to buy gold and silver, because there is no counterparty risk at all. And I'm talking physical. I don't mean ETFs, because that is a structure which can be interfered with. You don't have possession. You can't get possession from an ETF unless you're an authorized participant. But here we're talking about the authorized participants going bust. It's got to be physical. And, sort of things like, the forward market in London, the futures market on COMEX, in that sort of crisis, they'll go as well. I mean, it's as simple as that.
Another question related to this about the implications to an ordinary person, such as a real estate owner, in the case of a bank crisis. Alasdair, this is from Sarah Taylor. How do you think countries such as New Zealand, Australia, and Canada with highly leveraged housing markets will fare if a major globally significant investment bank, GSIB, collapses? Is it necessary that they all go down together? Also, would it be interested to hear your thoughts as to the prospects faced by countries such as New Zealand that have no remaining physical gold reserves, so how they can take care of themselves? Same thing with Canada. But can you first take that first thing for how will the real estate market, especially that's highly leveraged, be affected by a banking crisis?
Yeah, well, we saw with the Lehman crisis that a highly leveraged property market is extremely vulnerable. It's obvious that that's the case, because where a market depends on mortgage finance for its valuations and for buyers, and if buyers can't get mortgage finance, then basically prices go down. Now, that having said, I don't think we will get that banking crisis quite in that form. But what I do see is that rising interest rates will undermine property prices to begin with. And then at some stage, the collapsing purchasing power of a fiat currency will mean that in fiat currency terms, the value of a physical property, like whether it's a residential property or even some commercial properties, those values will begin to rise. But in real terms, they will still be falling. But what matters as far as people who have managed to continue to finance their mortgages through the process is that the real liability of a mortgage will go down. It will fall substantially. So I think the key to it is, if you sell your house, for a start, it takes time. And secondly, you end up with cash, whether it's Aussie dollars or US dollars or New Zealand dollars, whatever. You're going to end up with cash. What are you going to do with the cash? Put it into gold and silver, absolutely fine, but that's not everybody's cup of tea. I think what most people selling a property would do is they would look to buy another property. They would look to replace what they have with another property. And after all, you need to have a roof over your own head. So selling property isn't really an option for most people. What it is something that is likely to happen to people who are foreclosed upon. Now, I think in a general crisis, the banks and mortgage providers will be lent on by central banks and government not to foreclose, because it would just make the situation far worse. So assuming that everybody is in the same boat, if you can't manage your mortgage payments at that stage, there is a possibility that you won't be foreclosed upon. But once the purchasing power of the currency starts declining because of the general crisis, because of the John Law situation, which I've just described, then under those circumstances, you will find that your property prices will rise in currency terms. I've quoted on your show before the situation in 1923 in Berlin, where you could buy a 6-bedroom house in a good part of Berlin for the equivalent of $100. But the equivalent of $100 probably was many millions of marks. Now, before the war, that property like that might have been valued at something like, say, 500,000 marks or something like that, or maybe even a bit less. So in paper currency terms, the price has gone through the roof. But in gold terms, it has completely collapsed.
Yeah, the missing part of that story was that $100 US would have been approximately 1 ounce gold coins.
Absolutely. It was the dollar at that time was convertible into gold at the rate of $20.67 to the ounce. So you're talking about less than $5. 5 ounces of gold would buy you a 6-bedroom house in a posh part of Berlin. That's what happens to prices when a paper, a fiat currency collapses. Meanwhile, I wouldn't know what the price was in paper marks. It would have been, hundreds of millions. So, but if you got a mortgage on it, if you took it out and got a mortgage on it, then, your mortgage becomes, pennies, really, in real terms. So if you can survive through with a mortgage on this, then you would come out of it okay. Okay in that sense, but you've still got to live at a time when your money buys you virtually nothing. And that's a different problem.
The last or second to last statement you made there about mortgage holders those who are buyers of properties that owe on a mortgage coming out with an advantage should the fiat currency devalue sharply because it becomes so much easier to pay their mortgage. We've rarely seen situations where the banks don't take care of themselves at the expense of others. Like you were saying earlier, rather than bailing out the depositors, the government is much more likely, or the central banks are much more likely to move to bail out the banks, that sort of thing. Isn't there a likelihood, or have we seen examples historically of a repricing or a recalculating of mortgages based on the adjusted landscape of a devalued currency, rather than letting the people who are owing on a mortgage come out ahead?
That's virtually impossible to do, because a mortgage contract is a mortgage contract. The only thing that can happen is if it is within the terms of the contract, the mortgage company could decide to call its money in. But, no mortgages, to my knowledge, actually have that clause that without due cause and let, you've continued to make the payments, you continue to behave within the terms of contract. I don't think there's any mortgage contract which allows the mortgagor to call in the loan. So I just don't see that. And not only that, but, in that situation, inherently we have got weak governments that intervene in everything. The idea that they would stop intervening in a crisis, I think, is actually very unlikely. I think they would, they would lean on everyone not to be nasty to people in distress. I'm sure they would, because from the government point of view, if the financial sector fails to support homeowners and decides to foreclose and whatever, then the cost basically is a burden that ends up on government, and governments are not going to want that. They're going to lean on their licensed banks and licensed mortgage providers within the terms of their license, effectively to do what government tells them to do. I mean, that's inevitable.
We've certainly seen in the last year and a half here. Well, I mean, my mom told me from when she was a kid in the Great Depression, the number of farms that were foreclosed on. And maybe you're saying there that that's because people couldn't pay their mortgage. They couldn't keep up their payments. They couldn't service their debt, and they did lose their properties because of that. And that's certainly a risk for people who haven't positioned themselves to come through. If we're the mainstream investments or lack of savings or that sort of thing on the part of the ordinary person, or only holding fiat denominated assets, that sort of thing, does put most people at grave risk.
Yes, I would also add, if I may, that the government believes it learned lessons from the 1930s. It saw how, sort of the banks foreclosing on property. I mean, this is something that Irving Fisher, the economist at the time, commented on. He said that the problem with banks foreclosing is that they drive down the prices of the assets which secure their other loans. So all that happens is that it's a sort of self-feeding collapse in asset values, because banks are trying to liquidate everything under those circumstances. And so much has been researched, so much has been written to try and prevent this happening again, that you can be sure of one thing, and that is that governments will do everything in their power to ensure that wholesale liquidation just does not take place.
We have one final question here about, you've talked quite a bit about gold and silver as being a risk or counterparty riskless asset that people should consider. David Field says, how would a bimetallic standard work? And what about the arbitrage aspects? Would this ratio be allowed to float freely?
Well, bimetallic standards, which, just to explain to everyone, are fixed rates between two metals, which are regarded as, if you like, as the basis of a nation's money, convertible either into gold or silver, at the holder of the pound notes or dollar notes, whatever it is, choice. That is a true bimetallic standard. Now, that doesn't work because things change, and the relationship between gold and silver is bound to shift. So the way in which they get round this is they just go on to one standard, which is gold, and coins are then issued in the other metal, which in this case it will be silver, but at such a rate that it discourages anyone from melting down the silver coinage and swapping it for gold. Now, that also means melting it down, say, in America and swapping it for gold somewhere else because of the price differentials, across borders. So it's actually quite easy to do. And you've done it I can't remember the exact details, but it's happened in America. I mean, when you sort of went on to a proper gold standard, you ensured that the silver coins, the silver dollars, were contained less silver than a dollar's worth, if you like, of the gold equivalent. So it's easy enough to do, and I don't see. I mean, first of all, we've got to get governments to understand that they've got to go onto a metallic standard, but. Assuming that hurdle is overcome, I don't see governments going back onto a dual standard. I just think that they would underprice silver relative to gold to ensure that both of them continue to circulate.
A lot of people are asking also a general question. It keeps appearing here. I don't know if you're willing to take a crack at it before we wrap, and that is about the notion that the price at which silver and gold are trading on the major exchanges, the COMEX and the LBMA, are being set by futures contracts and derivatives. There's two questions. One is, how does that actually work? How do futures contracts actually affect the spot price at which the metals are available for exchange? And then secondly, if there is no change to this overall system, then how should anyone have confidence that we're ever going to see a honest market in gold and silver pricing in this environment?
Well, where do we start with this one? If you look at the paper markets like COMEX and the London forward market, I mean, the London forward market is roughly 8 times the size of COMEX. So on COMEX, you're looking at the tip of a floating iceberg, if you like. I think that's the best way to look at it. What we can see on COMEX is that the establishment, by that I mean bullion bank trading desks, are short to the speculators, and they're short to the speculators in quite large amounts. Now, that generally means that they will trade against a short position. That's fine, but always they will try and recover their short position at the margin where they can. So if the price of gold rises, let's say, for whatever reason, they will wait their opportunity, and when things are quiet, they will hit the price to try and take out the stops. And they have got very, very compliant longs to enable them to do this. And by that, I mean hedge funds. Hedge funds are not interested in taking delivery. They're not interested in catalactics, the theory of exchange. They're not interested in economics. They're just interested in trading. And their trade is a pairs trade. The pairs trade is dollars and gold. So they sell dollars, buy gold, or sell gold, buy dollars. It's as simple as that. That's all they do. And what they'll do is they will, for example, they will look at the technicals at any one moment and decide it's the moment to buy gold. So they go in, they buy gold, and as soon as the technicals turn the other way, guess what? They're vulnerable to selling it. And it's very easy for bullion bank trading desks acting in concert, and I think this is a key thing, to hit the price at moments when they can see that these guys are vulnerable. I mean, they know at what levels, the sort of these vulnerable traders are, and they have seen in the past that some are more vulnerable than others. So, this is the sort of information that a jobber, which is what we used to call these people in the London market, has up his sleeve. And this is why he can make fairly tight prices. And this is why, despite he's always running a short book, he makes decent profits year after year after year. And it's the hedge funds who fall for it. I mean, I remember when hedge funds first started, they were dubbed masters of the universe. I mean, it's absolutely crazy. They're nothing of the sort. They're just normal investing idiots. And I think another point I'd like to make about gold is that it's not an investment. It is money, and therefore you spend it. And anyone who looks at gold, physical gold, as part of a portfolio, I think is making a fundamental error. It's not that at all. It is money. So the comparison that you've got to make is, and I'll come back to it again and again and again, the comparison you've got to make is how frightened are you of the fiat money system? Therefore, how much are you going to have out of the fiat money system? That is what you've got to decide, I think. And it's probably the most important decision of anyone's life, particularly over the next 2 or 3 years.
Now, the last question is the second most important decision of anyone's life. That's from Sarge 27271. What is Alasdair's favorite ice cream flavor?
Well, here in Devon, in England, the county is famous for something called clotted cream. I don't know that you've got the equivalent in America, but clotted cream is basically made out of the milk is heated to the point where the cream floats on the surface and is then skimmed off. They do clotted cream ice cream, and I can tell you that it is a real delight. It is absolutely loaded with cholesterol, so not recommended for people who have a cholesterol problem, and I love it. But I do have a problem insofar as, I got to go sort of slightly easy. I'm trying to lose a little bit of weight at the moment. I probably don't look like I need it, but I've been told by my doctor that I should really get back to where I was at age 21. So I got a little bit more to go. But I would say that's my favorite ice cream. Next to that is vanilla. I don't really sort of go for some of these fancy types. Though, my goodness, we were offered so many different types of ice cream.
Is the clotted cream ice cream have any flavor at all? Is it just a natural flavor?
Yeah, it's a natural flavor. It's a natural creamy flavor. But clotted cream's got, because of the process, the way it is made, it's got a specific flavor to it. And it doesn't take a lot of freezing, I can say also.
Well, we're going to have to run off to Devon right away. Okay, so you want to tell people where to get get access to your work?
Yep, goldmoney.com. I publish an article every Thursday. It comes out sort of early afternoon EST. And I do a market report on the Friday. So go to Gold Money, hit the research tab, and just go from there. Thank you very much, Alasdair MacLeod, Head of Research at goldmoney.com, for joining us again for this little, not fireside chat, but chat as we like to have with you as often as we can. And we look forward to your insights, and your answers to our viewers' questions are greatly appreciated by all of us. So thanks for joining us again here on Liberty and Finance. That was my pleasure, DK.
This week's specials with Miles Franklin Precious Metal Investments. Austrian Philharmonics for only $365 over spot. Type 2 Silver American Eagles for only $725 over spot. And limited mintage San Francisco Mint Type 2 Silver American Eagles for only $725 over spot, sold in quantities of 500. Call us at 1-888-81-LIBERTY. That's 1-888-815-4237.